Ever feel like interest rates are a massive puzzle that takes forever to crack? Well, today we're going to not only solve that puzzle, but we're going to turn you into a master and help you understand that even though everyone is talking about these high interest rates and everything that's going on, now may be a perfect time to buy and secure that interest rate below 5 or 4 or whatever you desire. So stay tuned. What's up, guys? Jeremy Kane, eXp Realty, living in the Denver suburbs. Today, this is such a hot button topic, and I'm very excited to dive into it with a few tried and true methods and some things that probably you don't know about. They're not talking about these things in the headlines. But first, as always, please like, comment, subscribe, share this on your Facebook page or with anybody that may be looking to buy a home and just is so down and out on these interest rates, because I'm here to give us a little bit of hope and give you a couple secrets to allow you to get the lowest interest rate possible and maybe not even have to worry about, the crazy market when the interest rates do come down that you may have to compete in. So stick with us and we'll go from there. All right, number one, this is absolutely something that is not being talked about enough, and what builders are doing. So you can purchase a very brand new home, and builders are partnering with lenders, which is not a new thing. And they're going out and they're purchasing these massive blocks of loans or money. And then they're able to provide that, since they're buying it in bulk, kind of like you go to Costco and buy stuff at cheaper prices for $500 that you don't need. They're buying loans like that and offering, maybe a 4.99. I was at an event last week and I talked to a builder with Richmond, I believe, and he said that they had bought $10 million in loan financing at a 4.99% interest rate. But you have to act quick, because just in 24 hours, not even in 12 hours, he said, we just released it today and we only have 3 million left. So if you're, lucky enough to do that, or you're paying attention, you're like, okay, now's the time to secure that new build. Then you can go in there, you can go under contract on a home, lock in your loan at that 4.99% interest rate if you use their preferred lender. And so that's how they're doing it. They're basically going to the Costco and buying a massive amount of loans because they know that they'll use them, and then they can offer those really, really competitively low interest rates and not add too much of the cost. So that is secret number one. So if you're finding that tip something you hadn't heard or thought about, please be sure to check in often, like, comment, subscribe, and come back as I try and break down these tips and these little tips and tricks that I find throughout the day to help you, my client, people in my sphere, because it's of utmost importance that we're getting the whole story. A lot of times when we're on the news channels and things like that, we don't have the whole story. So let's get into number two. Number two is something that's probably talked about. You've probably heard about permanent buy downs versus temporary buy downs. Temporary buy downs are super sexy on the front end. Not a huge risk factor there. You just would have to get, usually it makes sense that the seller concessions cover that buy down. So it's not your cash, it's buying down your interest rate, because it's really a dollar for dollar trade. Basically you put money in escrow and they're paying down, the interest rate 2 points for the first year, 1 point for the second year if it's a 2-1. And those are temporary, right? And the thing with that is everyone's promising all these refinances, and you can just refinance when the mortgage rate comes down. Well, I'm here to tell you, people said that the mortgage rates were going to come down in May of this year, and that's actually when they reached pretty high up and they started going up. So we're not exactly sure that the rates will come down much at all. And it's also very market dependent. If you are buying in a place where maybe, the market's slipping a little bit and dropping, well, if you're dropping on that debt to income ratio and you go to refinance, you might not have enough, down payment, so to speak, in equity in order to get that 80-20 if it just slips just a little bit. So really think about that. Also, if you're using down payment assistance, I hope that someone's telling you that you do have to pay that back in most cases when you refinance. So you'd have to gain that equity to cover that down payment assistance, to cover that buy down, or to cover that refinance. So it's not a foregone conclusion that you'll be able to refinance whenever you want when the rates are perfectly low and you're ready to roll. So that's the biggest thing with the 2-1 buy down. You might end up paying that 7-8% interest rate on the back end once the years have gone by, if the stars don't align and you have that opportunity to refinance. So let's talk a little bit about permanent buy downs. And I think these are things that people aren't talking about quite as much. And the big thing with a permanent buy down is you really want to make sure how long it's going to take you to make up that gain. So if I buy the interest rate down and say it saves me $100, but I pay, $1,000 for easy numbers to buy it down, then I will make my pay-in back in savings in 10 months. That's a pretty good turnaround. Most of these are between 12 and 24 months right now where your break-even point is, because you're putting that cash in up front and buying the rate down. So you save a little bit more as you go, but you're locked into that rate for the 30 years or 15 years, whatever you decide to do on that part of the mortgage. So that's something to absolutely consider, is taking that opportunity to buy down that rate. And when's your break-even point? The nice part about a permanent buy down is if the market drops, we're probably not going to see, the 3s and 2s in the interest rate that we saw back in, 2020, 2021, 2022. And so we have to understand that, the interest rate may drop, but if we're already in a home and we bought down the rate, say a point, right? Say we're quoted 7%, we got it down to 6. It might take a little bit till we're below 6. And then once we get to 6, we got to make sure that we're below enough, because there are costs associated with refinancing and all of that for it to make sense. There's no reason to refinance your home to save $25 a month. It just doesn't add up, because there are costs. I don't care what anyone says. When you refinance, you are using some of that equity, to pay for the closing costs and that kind of stuff. So those buy downs are absolutely an option. Make sure you dig a little deeper than, just refinance whenever, the time comes, because that may or may not be an option depending on your market and what's going on. So make sure you're aware of all of the things before you do take one of these permanent or especially temporary buy downs. The next one, and this is a special group that I'm going to dive into, is to consolidate your debt, right? Let's say you purchased a home in 2020, it's gained $150,000 in equity. If you have that ability, you may be able to do a cash out refinance. And you say, Jeremy, that would be crazy. I have a 3% interest rate, so on and so forth. Totally understand. But when we're looking at an overall financial picture, with the mortgage just being a small portion of the actual debt that you have, and absolutely probably locked in at a very good rate if you refinance in 2021 or the first part of 2022, or you purchased it then. But say you have $150,000 in equity, you're able to refinance, pull some of that cash out, and maybe pay off some of the other debts, credit cards, car loans, anything else that you have that may have a much higher interest rate. So let's say we have a credit card, $60,000 in credit card debt, $40,000 in car loans, and those, are the car loans interest rate is 8 and the credit card interest rate is 22%, which I know those are moving quite a bit up. So if you're in that situation and that's you, well, if you took that $100,000 of debt, maybe you have $3,000 of monthly obligation to pay off those minimum payments. And if you're paying off those minimum payments, you're just pretty much, chipping the iceberg away with a, pencil or something. So you're not doing very much of your principal buy down. So you're just paying interest and you're paying interest and you're paying interest. So it could be very functional to take $100,000 out of your home as a advantage to great appreciation that we've seen, and lock it in at a 6% interest rate. And now all of a sudden, maybe your mortgage is $2,000 plus an added $1,000, and you're $3,000 total for your monthly payment. These are completely made up numbers, but if it makes sense to take this $3,000 obligation and bad debt over here, combine it with your home, and maybe we're paying $1,000 a month at a 6% interest rate. All of this debt is wiped off. It's all locked up in your home, and you're absolutely, taking advantage. Then your cumulative interest rate of your debt may be improved. right? Sure, your mortgage, that interest rate probably is a little bit higher because you had to refinance in a higher interest rate time, but we don't have the 22s and 23% and the 8% car loan and all of that on this side. So it could be a strategic play in order to lower your cumulative interest rate on the debts that you pay monthly versus just focusing on that mortgage interest rate. Because even with the higher mortgage interest rates right now, it is certainly lower than some of the short-term credit cards and cars and different loans that we can get. So it could make a ton of sense for you to take advantage of a refinance. Even though you're going to boost this interest rate up, you're going to get rid of all of this debt and drop those interest rates to zero. So that's something that you can absolutely look into, and I'd be happy to talk to you about that. Because it's a little bit specific, right? Somebody who has a decent amount of debt, but who cares if you're paying 2% interest rate over here on your home, but you're paying 25% interest rate on this other debt over here, and that's really weighing you down. So you have to look at your finances from a bird's eye view, not just from, in the mix in this one situation. And so I hope that helps. I hope it wasn't too confusing, but if you're interested in that, I would absolutely be happy to connect you with a lender who can absolutely look at everything and dial it in. So if you want to do that, just comment below debt, and I will get a lender in touch with you to help you understand what we can do to get you out of that, hamster wheel of revolving debt. So there we have it. My 3 tips to secure lower interest on your monthly payments when purchasing or refinancing a home. I hope that helped. You are now equipped with just the knowledge you need to make those right financial choices. And if you're interested in talking more about purchasing a home or a loan or all of this stuff, and maybe interest rates are over your head, I'd be happy to sit down with you in person, answer your individual questions, because everyone's situation is just a little bit different. So reach out to me, give me a call, 303-210-0378, comment below, hit me up on IG, all of those things. I can't wait to discuss how we can take advantage of this market. Yes, I said take advantage, and maybe lock in an interest rate that is acceptable to you as we move forward. Jeremy Kane, living in the Denver suburbs. We'll catch you next time.